Your underpinning is always corporate profits.
Right.
Is it profits from a better revenue, or is it profits from a well-run corporate America?
Well, this is a stronger revenue environment than we've seen for a good long period of time. Business costs are rising this time. They're getting a good deal of that recycled through the economy. A big piece of this, again, is the rebound that we've seen in the energy sector. But away from all that, this is a legitimately stronger growth environment than we've seen since any time since 2010.
I mean, this weekend, Mr. Buffett out. And with his venerable age, I mean, I'm sorry, it's a big deal. Good morning, Doug Cass of Seabreeze Investments, who was asking questions of Mr. Buffett a few years ago in the annual letter and all that. It's just about a long-term investment for Mr. Buffett. I mean, I know that's what you're going to say. You're going to say, that's what we want to do long-term. How do you avoid the shock in the moment, the immediacy of the new volatility?
Well, a good idea is to not be selling volatility when it's already at a record low price. We have to remember that the tranquil stock market of 2017 was quite unusual. That good long period of time since mid-2016 with remarkably low volatility and powerfully strong returns. Unfortunately, the story is a little different in 2018, where we're dealing with two things at once. That is tighter monetary policy, that is competition for savings around the world, including to finance U.S. budget deficits, and the stronger earnings environment. I think this nets out as a good environment for investors, but it is going to be more volatile and the returns are not going to be as strong as the pristine 2017.
Okay, are we expecting, Steve, are you expecting much more volatility, and does it hit other asset classes?
Well, I think that's been a really important question, is that what happened in early February, where you had, to a certain extent, a small amount of market failure in terms of volatility products and so-called efficient markets, where the equity market had tremendous volatility relative to every other asset class. I think that was an exaggeration. And when you can see, as Tom mentioned, the VIX down at 16 now from, where it was on an intraday print of about 50, that again, is a little bit of a mistake in the marketplace. But to say that we're not going to have any interest rate or credit volatility or a generally stronger trend for volatility in equities markets, I think that would be a mistake too. I do think that, again,
right,
this has been an exaggeration in the equity market, and we have a pretty decent environment, but we are not entirely out of the woods from the things that should be impacting markets this year.